As 2025 commenced, the U.S. economy appeared robust. The unemployment rate stood at a seasonally adjusted 4% and inflation rates were projected between 2.2% and 2.4% for the year. These indicators suggested a stable economic environment, fostering optimism among investors and policymakers alike. However, the economic landscape began to shift with the introduction of aggressive trade policies. President Donald Trump's administration implemented sweeping tariffs, including a significant 145% increase on Chinese imports. These measures aimed to bolster domestic manufacturing but introduced substantial uncertainty into global markets. The immediate impact was a sharp decline in investor confidence. On April 2, 2025, global stock markets experienced a significant downturn, with the Dow Jones Industrial Average plummeting by 4,000 points over 2 days. This event marked the most substantial decline since the 2020 pandemic-induced crash. Financial experts voiced concerns over the potential long-term effects of these trade policies. Ray Dalio, founder of Bridgewater Associates, likened the tariffs to throwing rocks into the production system, highlighting the disruption to global supply chains. He emphasized that such measures could lead to consequences worse than a recession, drawing parallels to economic conditions of the 1930s. The Atlanta Federal Reserve projected a 2.4% contraction in GDP for the first quarter of 2025. This forecast, coupled with declining consumer confidence and rising unemployment, signaled mounting economic distress. The office real estate sector, which had shown signs of recovery, faced renewed challenges as companies reconsidered leasing plans amid the growing uncertainty. Retail and consumer spending take a hit. By February 2025, consumer sentiment began deteriorating rapidly. Higher tariffs translated to increased prices on a wide range of imported goods, from electronics to clothing. According to the University of Michigan's Consumer Sentiment Index, confidence fell to its lowest level since mid-2020. Big-box retailers like Walmart and Target warned of earnings shortfalls, attributing them to weakened purchasing power and tighter consumer budgets. Layoffs followed. In a joint earnings call, executives warned of a demand contraction wave that could persist throughout the year. Foot traffic to brick-and-mortar stores decreased significantly, with online retail also slowing due to rising shipping and fulfillment costs. Amazon, often seen as recession-resistant, reported a rare quarterly loss in Q1, citing supply chain snarls and shrinking basket sizes. Technology and startup struggle. The tech sector, which had enjoyed over a decade of near-uninterrupted growth, started to wobble. Venture capital dried up as investors pulled back on risky bets, triggering a funding freeze across Silicon Valley. Companies like Stripe, Airbnb, and Meta began cutting staff. More than 180,000 tech workers were laid off in Q1 2025 alone, eclipsing the tech bloodbath of 2022. Even AI companies, previously immune to economic downturns due to growing enterprise adoption, felt the pressure. Many were forced to delay product rollouts or pivot to subscription-based models just to survive. Valuations cratered. The once high-flying OpenAI reportedly slashed its internal revenue forecast by 40%. Manufacturing and supply chains under siege. America's manufacturing sector bore the brunt of the Trump administration's aggressive trade policies. Key machinery parts and rare earth materials from China were subject to punitive tariffs, leading to increased production costs and delivery delays. Automakers like Ford and General Motors issued temporary shutdowns at several plants. According to the Institute for Supply Management, ISM, the manufacturing PMI fell to 44.6 in March, a strong contraction signal. The National Association of Manufacturers warned that the U.S. could lose up to 1.2 million manufacturing jobs if current trade tensions persist. Housing market cooling rapidly. While housing prices had shown resilience in recent years, cracks began appearing in Q1 2025. Mortgage rates hovered around 7.5%, pricing many first-time homebuyers out of the market. The National Association of Realtors (NAR) reported a 12% drop in home sales in February alone. Major homebuilders like Lennar and D.R. Horton revised their annual guidance downward, and some canceled new developments altogether. Real estate tech companies like Zillow and Redfin saw massive reductions in web traffic, with fewer listings and slower market turnover. Wall Street, volatility returns. Stock markets reeled from the cumulative effect of tariffs, weak earnings, and geopolitical jitters. The S&P 500 officially entered bear market territory in mid-April after falling more than 20% from its January highs. Volatility was the name of the game, with wild swings becoming the norm. Banking giants like J.P. Morgan Chase, Goldman Sachs, and Bank of America posted underwhelming Q1 results. Consumer lending was down, credit defaults began inching up, and the IPO market dried up almost entirely. Investors fled to safer assets like U.S. Treasury bonds and gold, while cryptocurrencies experienced a brief revival as a hedge against economic instability. Bitcoin surged above $60,000 before stabilizing in the high $50,000s. International impact. The global economy wasn't spared. China retaliated with its own tariffs and reduced U.S. agricultural imports. European Union countries began distancing themselves from American goods to avoid secondary sanctions. Emerging markets faced capital outflows as investors sought shelter in safer U.S. assets, ironically reinforcing the dollar's strength while simultaneously harming export competitiveness. Global institutions like the IMF and World Bank revised their 2025 global growth forecasts downward, warning that the U.S. recession could drag the world into a synchronized slowdown. Federal Reserve's monetary policy measures. In March 2025, the Federal Reserve faced a challenging economic landscape characterized by declining consumer confidence and escalating trade tensions. Despite these challenges, the Fed opted to maintain its benchmark interest rate within the 4.25% to 4.5% range, citing persistent inflation concerns. Neil Kashkari, president of the Federal Reserve Bank of Minneapolis, highlighted the significant drop in consumer confidence, describing it as the most substantial decline since the onset of the COVID-19 pandemic in March 2020. This sentiment underscored the delicate balance the Fed aimed to strike between curbing inflation and supporting economic growth. To assess the resilience of financial institutions, the Fed released hypothetical scenarios for its annual stress tests, envisioning a severe global recession with heightened stress in both commercial and residential real estate markets, as well as in corporate debt markets. These measures aimed to ensure that large banks could continue to lend to households and businesses during economic downturns. Federal government's fiscal policy initiatives. On the fiscal front, the federal government grappled with the economic repercussions of its own trade policies. President Trump's administration imposed steep import tariffs, including a 10% tax on all nations and a 145% levy on Chinese imports, aiming to bolster domestic industries. However, these measures led to increased costs for consumers and businesses, exacerbating the economic slowdown. Former UK Prime Minister Gordon Brown criticized these tariffs, warning that such protectionist policies could lead to a breakdown in the global economic order and potentially trigger a depression akin to the 1930s. He advocated for a coordinated global response, including synchronized interest rate cuts, to mitigate the negative economic impact. Domestically, the administration faced criticism for its handling of immigration policies, particularly the deportation of migrants to El Salvador's controversial megaprison, Socote. These actions raised legal and human rights concerns, further complicating the administration's policy landscape. Rising social discontent. As job losses mounted and household incomes shrank, public frustration began spilling into the streets. According to data released by the U.S. Bureau of Labor Statistics in early April 2025, unemployment had climbed to 5.9%, up from 3.7% just a year earlier. The hardest-hit sectors included retail, technology, logistics, and manufacturing, with many companies citing reduced consumer demand and high input costs due to tariffs. Homelessness on the rise. Major cities like Los Angeles, San Francisco, and New York reported double-digit increases in homelessness. Tent encampments grew rapidly on the outskirts of urban centers, while shelters struggled to keep up. Local officials pleaded for federal aid, warning of an emerging humanitarian crisis. Youth and college graduates. Perhaps the most vocal group affected was Gen Z. A growing number of college graduates found themselves unemployed or underemployed, despite holding degrees in high-demand fields. On platforms like TikTok and Instagram, the hashtag #NoFuture2025 began trending, with millions of posts expressing disillusionment, anger, and calls for political change. Shift in political landscape. As social unrest grew, public trust in institutions sharply declined. Midterm fallout. The 2024 midterm elections had already indicated a divide in American politics, but the recession intensified the rift. With the economic downturn lingering into spring 2025, voter approval for President Trump dropped significantly among moderates and independents, according to a March Pew Research poll. His aggressive trade policies, though praised by nationalists, were viewed as contributing factors to the inflationary pressures and global tensions. Rise of populist movements. Frustration with both major political parties gave rise to independent and populist movements. In states like Michigan, Wisconsin, and Pennsylvania, new grassroots organizations began advocating for economic nationalism, universal basic income, UBI, and sweeping labor reforms. Democratic response. In contrast, progressive leaders within the Democratic Party pushed for massive public investment, green jobs, and stimulus checks. Senator Elizabeth Warren and Representative Alexandria Ocasio-Cortez held rallies urging Congress to pass a people's bailout package. Their message: bail out workers and families, not corporations. Global reputation and domestic tensions. The recession also impacted America's global reputation. International criticism. Allies in the EU and Asia voiced concern over the U.S.'s unpredictable tariff regime. Many global firms began diversifying away from U.S. markets, opting for more stable trade partners like Germany, Japan, or emerging economies in Southeast Asia. Race and class divide. Domestically, the recession deepened existing inequalities. Minority communities, particularly Black and Latino populations, faced disproportionate job losses. Protests emerged in major cities not only for economic justice but for racial equity as well, drawing parallels to the summer 2020 unrest. Mental health crisis. Reports from the CDC and mental health nonprofits indicated a surge in depression, anxiety, and suicide ideation, especially among young adults. With fewer resources and long wait times for therapy, many turned to social media to voice their despair and seek community. Cultural shifts in recession. Culturally, Americans began reevaluating their relationship with work, consumption, and success. Frugality renaissance. From YouTube to Reddit, recession-core content boomed. Budgeting tips, debt-free journey vlogs, and minimalist living channels surged in popularity. Consumers leaned into DIY solutions, couponing, and bartering communities. Changing work culture. Many workers who had tasted remote flexibility during the pandemic were reluctant to return to the 9-to-5 grind, especially if jobs were underpaid or precarious. This led to a renewed push for workers' rights, unionization, and better labor conditions. Risk landscape. Are we out of the woods yet? As of mid-April 2025, economists remain divided on the trajectory of the recession. Prolonged stagflation? The Federal Reserve has been walking a tightrope. While inflation has cooled slightly, it remains sticky due to continued tariff-related price shocks and global supply bottlenecks. If consumer spending doesn't rebound, the U.S. could face a period of stagflation, a toxic mix of stagnant growth and high prices. Forbes. Geopolitical flashpoints. Tensions with China continue to escalate. The 145% tariffs imposed by President Trump have led to retaliatory actions from Beijing, disrupting global semiconductor and consumer electronics supply chains. These developments could further disrupt markets and hurt U.S. exports. Debt and deficit worries. The Congressional Budget Office, CBO, warns that increased spending on unemployment insurance, emergency housing, and public bailouts is swelling the national debt, which has now crossed $36 trillion. Fiscal conservatives argue this could lead to higher taxes or cuts to social programs in the near future. Green shoots and signs of recovery. Even in the bleakest moments, hopeful indicators are beginning to emerge. Manufacturing renaissance. Some domestic manufacturing sectors, especially semiconductors, clean energy components, and aerospace, are seeing fresh investment, partly due to reshoring efforts and demand for supply chain security. AI and automation startups. Startups specializing in AI-driven logistics, remote work infrastructure, and automation tools are attracting venture capital. Investors are beginning to see 2025 as a potential dot-com crash redux, an ugly moment that could precede enormous digital growth. Housing market stabilization. Though housing prices fell in Q1 2025, lower mortgage rates and institutional investor activity are beginning to stabilize prices in key regions. REITs focused on rental properties, especially in southern states like Texas and Florida, are showing resilience. Investor strategies in a downturn. So, how can smart investors navigate this volatile environment? Defensive stocks and utilities. Sectors like utilities, consumer staples, and healthcare tend to outperform during recessions. Analysts recommend reallocating portfolios to include dividend-paying companies with strong balance sheets. Energy and commodities. Despite recessionary headwinds, global demand for energy, especially liquefied natural gas, LNG, and uranium, is driving gains in select commodity markets. With the shift to cleaner energy, uranium ETFs and critical mineral miners are gaining traction. Dollar-cost averaging and index funds. Financial advisors continue to promote long-term investing through index funds using dollar-cost averaging. For younger investors, this downturn is an opportunity to accumulate assets at discounted valuations. Emerging markets diversification. Due to U.S. instability, some investors are diversifying into emerging markets, particularly India, Vietnam, and parts of Latin America, which are posting stronger growth and attracting global supply chains. Lessons learned. Every recession leaves behind a legacy. What has 2025 taught America? Globalization has limits. Over-reliance on international suppliers exposed major vulnerabilities. There's now bipartisan momentum to revive domestic industry. Trade wars have consequences. Protectionist policies can backfire, hurting consumers and triggering global retaliation. Economies thrive when cooperation outweighs confrontation. The safety net matters. Social safety programs, once viewed as bloated, proved crucial in avoiding mass suffering. Expect renewed debate on universal basic income, student debt forgiveness, and healthcare reform. Digital resilience is key. Companies with strong cloud, remote work, and automation infrastructure fared better. The future belongs to the digitally adaptable. Investor patience pays. Historically, those who stay the course during downturns and reinvest in fundamentals emerge ahead when the tide turns. Final thoughts, rebuilding an American dream. The recession of 2025 is not just a blip on the economic radar, it's a generational stress test. It has exposed weaknesses in policy, governance, and corporate practice, but it has also sparked conversations about fairness, reform, and resilience. To the American investor, this is not a time for fear, it's a time for strategic thinking and long-term positioning. As Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. The recovery won't be immediate. But as always, history rewards those who prepare, not panic. Thank you for joining us on this journey through the United States recession of 2025. Subscribe to Investment Stories for more deep dive narratives that decode the markets and the forces shaping our financial future.